Hello everyone, my name is Zach Carruthers. I'm a financial advisor from LPL Financial, office of James Rockwell and Zach Carruthers. Today we're going to talk about preparing for retirement and the steps that you can take to better prepare for your retirement. On today's video, we're going to talk about 5 agenda items. That is where to start, income and expenses, Social Security, how much money will you need, and are you ready to retire? So first, let's dive into where to start. Let's start with asking yourself the following questions. Where will I live? What will I do? How much money will I need? How much money do I have? And what are likely health-related issues? Having read these questions, I'm sure that you've thought of several others that are more specific to you and your situation. So it's a great idea to start a file as an organizer for retirement to keep all those questions, answers, and other information that you may come up with. So let's dive into a budget. And what does a budget do? Well, a budget is basically a spending plan. It takes into account all of the income that you expect to receive and allocates that income to specific expenses that you expect to have over the coming months. The spending plan shows us where our income goes. It identifies the specific expenses that we'll face and how much we will need in terms of income to cover those expenses. Now, our plan can also help us set limits on some expense items. So let's say that when you finished your budget, you realize that you spent several $100s over the past few months taking you and your family out to the movies. Without a budget, you probably wouldn't have as much of an idea as to how much you were spending taking your family out to the movies. But with your budget, you might see that you could actually rent DVDs 6 times a month for way cheaper and stay at home and watch those movies with your family. Lastly, a spending plan can help you achieve your financial goals by controlling your expenses. Additionally, it can potentially result in retirement savings lasting longer and help you towards your financial security. Now we'll talk about income and expenses. So first, you'll need to carefully look at your expenses. Unfortunately, there are usually more categories of expenses than there are income. So to make this easier, think about your expenses in 2 different categories. Break them down into fixed expenses and variable expenses. So what's the difference between a fixed and a variable expense? Well, fixed expenses are those that don't change over time. So what are some examples of fixed expenses? Things like monthly mortgage or rent, your auto loan, life insurance, auto insurance, and maybe a student loan payment. Now, variable expenses are those that change from month to month. So what are some examples of variable expenses? Think of things like food, medical expenses, auto repairs, your telephone, maybe utilities like electricity or gas, depending on the season that we're in. Let's look more closely at the fixed expenses that you need to include in your plan. When you're working on your list of fixed expenses, think about things like property taxes or quarterly estimated income taxes. Your mortgage, including escrow amounts for insurance and taxes, or rent if you're renting. The amounts that you pay for water, electricity, gas, and cable TV if you have it. Insurance, that might include things like life insurance, homeowners insurance, and car insurance. And be sure to include any monthly car loan or lease payments that you may have. So you'll likely have many more variable expenses than you do fixed ones. Now, variable expenses are those that can vary widely in terms of cost from month to month. Consider what you'll be spending for. Think of things like food, both groceries for at home as well as eating out, clothing for you and your family, furniture and appliances, and not just the furniture or appliances, but maybe the repairs for that furniture and appliances. Gas, oil, and other maintenance items for your car. Entertainment. Think of things like movies, sporting events, concerts, day trips, weekend trips, etc. And don't forget about other variable expenses like co-payments for visits to the doctor, prescriptions if you have them, birthday and wedding gifts, vacation plans, and personal items such as haircuts, magazine subscriptions, newspaper subscriptions, etc. And again, try to put every single category of expense that you can think of into this draft spending plan. It will help immensely. So now comes the category of income. So stop and think about all of the sources of income that you'll have during retirement. You might have some earnings from a part-time job, or maybe if you start your own business, you may have some earnings from that. You may also have annual distributions from an IRA. Maybe you have pension income from a previous job or from military service. And of course, at some point, you'll have to begin taking withdrawals from your retirement accounts, your 401k account. Don't forget about interest on your saving account and any income that you may make from money market funds. And you may also be receiving dividends from stocks that you own or from mutual fund investments. And finally, you should take into account your expected Social Security benefit. Taking a look at last year's federal income tax return should help you quickly identify your current sources of income. So, this is the moment of truth. You certainly hope that when you get to the bottom line, your income is more than your total expenses. That's the ideal result. It means that you're probably going to be able to live within your retirement income. More important, it indicates that you have the opportunity to put that excess income to work, maybe increasing your overall savings. But it's entirely possible that your expenses might actually be greater than your income. And if that's the result, you're going to have to take a harder look at where you can cut expenses and possibly increase income. That may mean working part-time in retirement or postponing retirement to increase that income. Regardless of the bottom line that you reach when you do your initial draft budget, you'll have a much better handle on the financial situation that you're facing during retirement. And you'll be armed with all the detailed information to use in adjusting your income and expense projections. To start your net worth calculation, list out all of your assets. Keep in mind that you want to concentrate on actual assets and not income. Assets are any financial or material possession that have monetary value. Assets will include things like cash and bank accounts, stocks, bonds, mutual funds, annuities and retirement plans, life insurance. And keep in mind, it's the cash value, not the face value. Your home, your car, boat, RV, household furnishings, jewelry, books, coins, art. Remember that your assets are valued at the current market value, not what you paid for them and not what you hope to get for them when you go to sell them. Now, list out all of your liabilities. Liabilities are financial obligations or debts that you owe to others. Liabilities include things like mortgages, installment loans, credit card balances, unpaid taxes or bills, and other financial obligations. Remember that liabilities are also very different than expenses. They're often large amounts owed to others. Many are secured by an asset. For example, your house is collateral for your mortgage. And likewise, your vehicle or car is collateral for your auto loan. So now we actually get to the net worth equation. Subtract your liabilities from your assets, and that amount is your net worth. You'll probably be pleasantly surprised and maybe relieved. So why would you want to know your net worth in the first place? Well, your net worth can be helpful information to have when you're dealing with a lender and you're in a situation where, for example, your income isn't particularly high at this time, but you have significant assets to draw on if necessary. Preparing your will can be simplified when you've done your homework on your net worth, since you'll know right away what your assets are and what the values are of those assets. This information would also be helpful in planning ahead for your estate taxes. So when thinking about life insurance, you might conclude that only a moderate amount is needed, since your dependents have a significant financial cushions with all those assets available to them within your estate. Finally, your net worth is an indicator of how you're doing in terms of working towards the financial goals that you've set for yourself. For example, as you look at your IRA and 401k balances, you would get a good idea of how you're doing as far as making sure that you won't outlive your assets. So now let's discuss Social Security. You can begin receiving individual Social Security benefits anytime between ages 62 and 70. Your benefit amount will differ based on your full retirement age. This is based on your year of birth. For example, you'll see from this chart that a person born in 1948 has a full retirement age of 66. This means that he or she will receive 100% of his or her benefit based on credited earnings and Social Security tax paid at 66. For someone born in 1960 or later, the age for full benefits is 67. Let's see how starting to receive benefits early affects that amount. Starting your benefits early means anytime between the ages of 62 and your full retirement age. The early retirement reduction at age 62 ranges from 20% to 30% and is based on your birth year. For example, let's say that you were born in 1950. Qualify for a monthly benefit of $1,000 at age 66. That's your full retirement age. And you chose to be receiving benefits at age 62. Now, you would only receive a total of $750 due to that 25% reduction. So instead of that full $1,000 at the age of 66, you are receiving $750, which is that 25% reduction. In this example, if you waited until age 63, your monthly benefit would be reduced by only 20%. At age 64, the reduction factor drops to 13.33%. And at age 65, it's only 6.67%. So for those who need income right away, taking benefits early would be appealing, of course. But keep in mind, the benefits are permanently reduced. If you wait until after your full retirement age to start receiving Social Security payments, your benefit amounts are increased. So for someone born in 1943 or later, his or her benefit is increased by 8% for each full year benefits are delayed after reaching full retirement age. So the longer you wait, the higher your benefit. And remember that if you work past your full retirement age, more earnings are added to your Social Security record. As a result, if your lifetime Social Security earnings are higher, your benefit may be higher, in addition to the delay factor. So, will your benefits be subject to federal income tax? Yes. Your Social Security benefit will be subject to federal income tax if your combined income is above certain limits. Combined income is defined by Social Security rules as your adjusted gross income plus non-taxable interest plus 1/2 of your Social Security benefits. So you can see, for example, that a single person with a combined income of $30,000 would have 50% of his or her benefits taxed. And a couple married, filing jointly, with a combined income of $40,000 would also have 50% of their benefit taxed. So keep in mind that total income means money from all sources, things like employment, dividends, capital gains, and so on. So you can receive Social Security benefits while you're working. There is, however, a limit to the amount that you can earn before your benefit is reduced. For 2023, that limit is $21,240, and it is adjusted annually to account for inflation. This limit applies only up to the full retirement age, when it actually goes away entirely. So let's look at an example. Assume a person is age 62 and is receiving benefits, has a full retirement age of 66, and earns $21,720 a year. Well, in 2023, his or her annual benefit would be reduced by $1 for every $2 his or her earnings went over the limit. In this example, the earnings were $480 over the limit. That is, the $21,720 minus the limit of $21,240. So that would result in a total reduction of $240 in the annual benefit. That is that $480 divided by 2 to get you $240. There is a much higher limit for the year in which you reach your full retirement age. Also, the reduction in that year is actually $1 for every $3 in earnings. Obviously, the earnings limit is the key factor to consider between the age of 62 and your full retirement age. The good news is that the earnings limit no longer applies at full retirement age. So there's obviously a lot to think about regarding Social Security benefits, isn't there? I'm sure that you would agree that this topic needs to be near top of the list when you think about retirement and when you're preparing for retirement. So there's very helpful information as well as an easy to use calculator to actually estimate your benefits at the Social Security Administration's website. That is www.ssa.gov.
When you are ready to apply for your Social Security benefits, you should have the following items as seen here on the screen. However, do not delay filing your claim just because you do not have all of the documents. The Social Security Administration can still help you. Also, you should visit the Social Security Administration website to view a comprehensive list of questions that they may ask you, such as, what was your name at birth? And have you used any other Social Security number throughout your life? Remember that you should apply for benefits about 4 months prior to actually wanting them to begin. All right, so let's talk about how you figure out how much money you might need in retirement. Most financial experts suggest that you need about 75 to 90% of your current annual income to live comfortably in retirement. Now, how much will Social Security contribute to that 75 to 90%? Well, for the average person, Social Security may replace about 30 to 40% of the wages that a working person earned before retirement. Be sure to visit the Social Security website where you'll find an interactive retirement calculator, which will give you a rough estimate of what you can expect in Social Security benefits. Of the various sources of income, Social Security is approximately 30% of income on average. You'll need to calculate how much more you'll need to live comfortably in retirement. Once you determine how much Social Security you can expect to receive, you can then look at your other sources of income and figure out what makes most sense for you in your retirement. Keep in mind that we should not ignore inflation. Here is a brief perspective of the rising costs of living over time. Inflation is the rate at which the general level of prices for goods and services is rising, and purchasing power is falling. Unfortunately, in retirement, you will probably be living on a fixed income. However, the cost of basic essentials will continue to increase in price. This loss of dollars buying power over time can have an adverse effect on the real growth of your overall retirement account. So be sure to maintain a proper mix of investments in an effort to offset this inflation. Also, make sure to take inflation into account when you look at your overall expenses in retirement. On average, Americans are living longer, healthier lives. You need to plan on spending at least 15 to 20 years in retirement. And remember, there is a strong possibility that you may spend upwards of 25 years in retirement. As you can see here, the average 65-year-old male can expect to live to the age of 83, whereas the average 65-year-old female can expect to live to the age of 86. As you think about retirement, we also need to think about these medical expenses. Plan for rising medical expenses. Medical cost inflation can quickly erode your retirement savings. Now, this is an average, but a 65-year-old American couple retiring in 2022 will need about $315,000 to pay for medical expenses throughout retirement. And keep in mind, this does not include nursing home care. Medicare eligibility generally begins on the first day of the month that you reach 65 years old. If you're receiving Social Security benefits before the age of 65, you should automatically receive a Medicare identification card in the mail shortly before your 65th birthday. If you're not collecting benefits before the age of 65, you should enroll for Medicare about 3 months before you actually turn 65. Just because you're eligible for Medicare doesn't mean that you should enroll and pay the premiums right away. If you're still working and your employer's plan offers adequate coverage, you can save money by not enrolling until you actually retire. An extremely important point about Medicare is that you must pay close attention to application deadlines and rules related to applying for benefits. If you enroll late or drop out and enroll again later, you may pay higher premiums for the exact same benefits. So let's take a look at what makes up Medicare coverage. Here are the different parts as it relates to Medicare. Part A helps cover inpatient care in hospitals, inpatient rehabilitation facilities, and inpatient stays in a skilled nursing facility. It also covers hospice care and some home health care services. You choose the hospitals and facilities that you want to use. Part B helps cover medically necessary services from physicians, outpatient care, and some preventative services. As in Part A, you select your doctors and other providers that you wish to use. Part C, Medicare Advantage plans, involves private insurance companies and HMOs or PPOs that provide the hospital and medical insurance under Parts A and B. In most of these plans, you need to use the plan's doctors, hospitals, and other providers, or you will pay more. Part D is the prescription drug coverage. If you want this coverage, you choose and join a Medicare prescription drug plan from private companies approved by Medicare. Most Medicare Advantage plans include some prescription drug coverage. You might also want to consider what's known as a Medigap plan, which covers amounts that Medicare does not pay. These policies are offered by private insurers not affiliated with Medicare, and costs vary by level of coverage. So now let's dive in to the Medicare premiums for 2023. Most people do not pay a premium for Part A because they have 40 or more quarters of Medicare covered employment. The premium is about $506 per month if you didn't pay Medicare taxes while working. Part B's premium ranges from $164.90 to about $560.50 per month, depending on that adjusted gross income that you show on your tax return. For Part A, the hospitalization portion, the 2023 deductible is $1,600 for each hospital stay of 1 to 60 days. There are daily copayment amounts for stays longer than 60 days. In a skilled nursing facility, the copayment is $200 per day for days 21 through 100 each benefit period. Under Part B, the annual deductible is $226. After you reach that deductible, you generally pay 20% of the Medicare approved amount for services. So before we leave Medicare, I want to remind you to pay close attention to the deadlines for enrolling in Part B. There are penalties for enrolling late, such as the possibility of having to pay a 10% higher monthly premium. More information is available to you at the Medicare website. That is www.medicare.gov. So let's talk about that Medigap policy. A Medigap policy is a health insurance sold by private insurance companies to fill the gap in original Medicare plan coverage. Medigap policies help pay some of the health care costs that the original Medicare plan does not cover. If you are in the original Medicare plan and have a Medigap policy, then Medicare and your Medigap policy will pay both their shares of the covered healthcare costs. Insurance companies can only sell you a standardized Medigap policy. These Medigap policies must all have specific benefits so that you can compare them easily. So now let's get into long-term care insurance. So who needs long-term care insurance? Well, anyone concerned about providing for potential future needs and looking to protect life savings and assets for themselves, their families, and their heirs. The average cost of nursing home care nationally is about $100,000. The cost of care does vary, obviously, state to state. So why should you plan? Well, most people over the age of 65 eventually require some long-term care services. And contrary to what many people believe, Medicare and private health insurance programs do not pay for the majority of long-term care services that most people need. Planning is essential to get the proper care that you might need in retirement. So, are you ready? Well, let's go through some of these planning worksheets. If you would like, download them on the landing page. If you're on YouTube, use the link in the description to get sent to the landing page where you can download these free Preparing for Retirement worksheets. The worksheets include a format for you to record your assets and their value today, project their value 10 years from now, and how those assets might grow between now and when you begin to retire. Another one enables you to see how your assets might provide income over a 30-year retirement. There are several worksheets to help you identify and estimate your monthly expenses today and 10 years from now. There's also one that provides a comparison of income and expenses, which of course is critically important for retirement. Another worksheet outlines where you might need to accumulate additional savings before retirement in order to enhance the chances that your retirement nest egg will last as long as possible. So now, let's take a look at examples of these worksheets to show how you can help prepare and get organized for your retirement. So let's look at a retirement timeline. Please keep in mind this summary outline as you approach retirement. Remember, if you do choose to start taking Social Security benefits at the age of 62, you will permanently receive a reduced amount. Please take a look at your brochure to figure out your full Social Security benefits, and you can also go online to calculate what you can expect to receive monthly from Social Security when you retire. So first, let's highlight Worksheet A, Today's Money. Record amounts for yourself and for your spouse in columns 1 and 2. Then add up the money across the rows for you and your spouse. And then write the total in column 3. Once you have the totals for each row in column 3, you will then add up all of the numbers in column 3 and write your total assets at the bottom there, again in column 3. Now let's get into Worksheet B, Your Money 10 years from now. The idea here is in column 1, you'll take the current value. Keep in mind this is from Worksheet A, column 3. Now use one of these asset growth factors. You'll see here that for 3% you'll use 1.344. For 5% you'll use 1.629, and for 7% you will use 1.967. Looking at column 3, this is where you get your asset value in 10 years. You simply multiply column 1 by column 2. Again, add in those total assets. So now let's get into Worksheet C, New Savings Between Now and Retirement. In column 1, is the estimated monthly savings amount. In column 2, it's the savings growth factor. Right above this chart, you will see the growth factors for what you use in column 2. And finally, in column 3, it's the value of savings in 10 years. That is simply column 1 multiplied by column 2 to get your output. Now, jumping into Worksheet D. Worksheet D is the monthly income over a 30-year retirement. In column 1, it's your accumulated assets. This is column 3 from Worksheet B plus column 3 from worksheet C. Column 2 is your income conversion factor. Use the conversion factors as seen on top of this chart. And column 3 is the monthly income beginning at retirement. Again, that is simply column 1 multiplied by column 2 to get your output. Worksheet E. Worksheet E is pretty lengthy, but this is super important. These are your monthly expenses today. If you would, just go line item by line item and get a really good idea looking at, credit card statements, bank statements, whatever it may be, to figure out what your exact monthly expenses are today. So once you've figured out your monthly expenses today in worksheet E, let's look at your monthly expenses in 10 years on worksheet F. In column 1, you will have total monthly expenses now. That is your monthly expenses from worksheet E. In column 2, you're going to have the 10-year inflation factor, which is 3.5%. And in column 3, you're going to have your total expenses in 10 years adjusted for inflation. That is column 1 multiplied by column 2. Now that we've got our expenses today and in 10 years figured out, let's look at worksheet G, which is comparing projected income and expenses. Here is the value adjustment factors that you will use for the sake of this chart. Column 1 is at retirement. Column 2 is inflation adjusted value factor. See that chart right above. And column 3 is the value in dollars at retirement for 1 month. That is column 1 multiplied by column 2. And column 4 is the total value in dollars at retirement. That is column 3 multiplied by 360 months. And finally, looking at worksheet H, this is additional savings needed before retirement in 10 years. You'll see here that we have the gap between the projected total value of expenses and the projected total value of income as seen from worksheet G. We have the additional savings factor, and then we have the additional monthly savings needed. That is, multiply line 1 by line 2 to get that actual savings amount. Again, we will use those savings factors as seen above this chart. So now that we are at the end of these worksheets and this webinar, here are a couple useful resources that you will have at your disposal. If you need them, feel free to write them down. Otherwise, contact me and I can send you in the right direction. Guys, thank you so much for attending this webinar. My name is Zach Carruthers. I'm a financial advisor, and my goal is to empower individuals like yourself to embrace financial confidence and unlock the path to a life truly well lived. If you have any questions, don't hesitate to reach out. My contact information is on the next screen. Thank you so much. Have a good one.